In a market full of noise, imagine locking in a portfolio of Canadian giants, holding it for a decade, and feeling confident about the results. That's the goal today. 10 Canadian stocks built to outlast the next 10 years. Before we dive in, take a second to hit the like button and subscribe so you don't miss any of our deep dive investing videos here on Bucks and Beyond. Stick around till the end and I'll reveal my single most future-proof Canadian stock, a pick you won't want to miss. These aren't penny stocks or speculative bets. These are proven companies with strong moats, global reach, and business models built to survive any economic cycle. We'll cover banks, energy, transportation, utilities, consumer staples, and tech, a diversified lineup for income, growth, and stability. By the end of this video, you'll have a watch list of Canadian companies you could hold for years or even decades with confidence. So let's get started. Canada's banking system is one of the strongest in the world. 6 major banks dominate the market, protected by high barriers to entry, strict regulation, and strong reputations. That stability makes them perfect anchors for long-term portfolio. Scotiabank takes the number 10 spot. It's the most international of Canada's big banks, with a significant presence in Latin America and the Caribbean. This global footprint provides a unique growth angle. Emerging markets can be volatile, but Scotia has leading positions in Mexico, Peru, Chile, and Colombia. Over the next decade, as these countries' economies expand and more people gain access to banking, Scotia is well positioned to capture growth from rising middle classes and increasing financial activity. On top of that, Scotia is known for its dividend. Historically, it has offered yields between 5.5 to 6.5%, making it one of the highest among Canadian banks. Its combination of stability, income, and international exposure, a solid long-term pick for investors who want both growth and dividends. Next is BMO, Canada's oldest bank, founded in 1817. Don't let its age fool you. BMO has been aggressive in pursuing growth. Its $16 billion acquisition of Bank of the West in 2023 expanded its footprint across the U.S. Midwest and West Coast. This move gives investors exposure to both Canadian and American markets, which is a great diversification play. BMO continues to pay a steady dividend, but its real growth engine is the U.S., where it can tap into new markets and customer bases. For long-term investors, this cross-border strategy is a smart way to diversify and benefit from two economies at once. Canadian banks are often underrated for their stability. Even during recessions, they have historically managed to maintain profits and continue paying dividends. That makes them a great foundation for a portfolio you can hold for a decade or more. Energy will remain a cornerstone of the Canadian economy, even as the world shifts toward renewables. Oil and gas aren't going away anytime soon, and Canada's resources are among the world's largest. These companies have adapted to changing markets, focusing on efficiency, sustainability, and returning capitals to shareholders. CNQ is Canada's energy powerhouse. It dominates in oil sands, heavy crude, and natural gas. That last piece, natural gas, is key as the world moves towards cleaner burning fuels. CNQ's scale and efficiency gives it a major advantage. Its low decline assets allow for steady production without consistent new investments. Plus, it consistently returns cash to shareholders through dividends and buybacks. Over the next decade, CNQ is likely to benefit from global energy demand while also being positioned for a transition to cleaner fuels. It is a reliable choice for income and long-term growth. Next is Enbridge, the country's pipeline giant. Unlike CNQ, Enbridge doesn't drill for oil, it transports it. Think of Enbridge as the toll road for energy. Its revenues are stable and fee-based, tied to how much product flows through its pipeline rather than the fluctuating price of oil. That makes it incredibly reliable. Its dividend, often between 6 to 7%, is among the highest in Canada, making it a classic buy and hold stock for income investors. And it's not just pipelines. Enbridge is investing in renewable energy projects and natural gas infrastructure, keeping it relevant in a changing energy landscape. If you want a stock that pays you while you sleep and remains essential for decades, Enbridge fits the bill. Canadian railroads are near monopolies, with only 2 major players controlling most freight transport. That makes them crucial to North American trade and nearly impossible to replace. CP comes in at number 6. Its merger with Kansas City Southern created the only single rail network that connects Canada, the US, and Mexico directly. This network positions CP perfectly for nearshoring, as companies move supply chains closer to home. Its infrastructure is unique, irreplaceable, and a true moat for long-term investors. CP owns access to trade flows that no other company can replicate, making it an excellent long-term hold. CN takes number 5 spot. While CP connects Canada, the US, and Mexico, CN links 3 coasts, the Atlantic, Pacific, and Gulf, giving it unmatchable tri-coastal connectivity. CN pioneered precision scheduling railroading, a strategy that allows it to run a tighter, more predictable network. This reduces costs, increases efficiency, and reinforces its economic moat. Even if competitors try to enter the market, they face nearly impossible barriers. CN isn't about explosive growth. It's about stability, efficiency, and long-term profitability. That makes it a must-have in a decade-long Canadian portfolio. Every balanced portfolio needs growth and consumer resilience. Couche-Tard, best known for Circle K, operates over 15,000 stores worldwide. Its business model is simple but highly effective. Acquire underperforming stores, optimize operations, and generate strong cash flow. Its product, fuel, coffee, and snacks, remain in demand no matter the economy, giving it defensive qualities while still offering growth. Couche-Tard's ability to execute acquisitions and scale globally makes it a unique combination of stability and expansion potential. Fortis, a utility company, takes the number 3 spot. It operates regulated electricity and gas utilities across Canada, the US, and the Caribbean. Utilities may not be glamorous, but they provide predictable earnings and reliable dividends. Fortis has raised its dividend for 50 consecutive years, a remarkable record. That predictability and stability make it a perfect core holding for long-term investors who want safety without sacrificing compounding potential. Number 2 is Shopify, Canada's crown jewel in tech. Shopify powers millions of online stores globally. Yes, it's volatile, but the long-term growth story is undeniable. E-commerce is still in its early stages worldwide, and Shopify provides the infrastructure, payments, and logistics that make it indispensable. Its ecosystem creates stickiness, keeping businesses reliant on its platform. That makes Shopify a long-term growth engine and the go-to Canadian stocks for exposure to innovation and digital economy. Finally, number 1, Brookfield Corporation. Brookfield manages over $1 trillion in assets and owns some of the world's most crucial infrastructure: hydro dams, toll roads, data centers, and the renewable power projects. It's perfectly positioned for megatrends like energy transition, global digitization, and AI infrastructure. Brookfield is building assets that will power the next decade of economic growth. Its asset management division collects steady fees from pension funds and institutional investors, adding stability to already robust business model. Combined with top-tier management team, Brookfield is arguably the most future-proof Canadian stocks to hold for the next 10 years. So there you have it, 10 Canadian stocks across banks, energy, railroad, consumer staples, utilities, and tech built to last for the next decade. From the reliable dividends of Fortis and Enbridge to growth engines of Shopify and Brookfield. This lineup gives you both stability and upside. Now I want to hear from you. Which Canadian stocks would you hold for the next 10 years? Drop your pick in the comments below. And if you enjoyed this breakdown, don't forget to like and subscribe and check out more investing insights here on Bucks and Beyond. Remember, the best time to start building a portfolio like this is now, not tomorrow. Thanks for watching, and I'll see you in the next one.